Hello and welcome to Finance Conversations. This is the 53rd episode of the Merging Life and Money Show, and I am delighted to be here today. For those of you who do not know me, I am your host, Marie-Jo César. I help professional women bridge the gap between life and money by teaching them the relevant financial skills and knowledge they need to take control of their money, manage their finances, and understand that they can live their best life with the money they have. Thank you for joining in today. If you are watching the replay, make sure to type #replay in the chat and leave me some comments and questions. Welcome, welcome, and welcome. I come to you live every Thursday at 5 p.m. Pacific Standard Time to share valuable information on how to achieve financial wellness and live your life with means and meaning. Today, my special guest, Lori Parker, will be talking about real estate investing and how to go about it. So Lori Parker is a team lead and managing broker for the Epic Home team at EXP in Washington State. She has 24 years in the real estate industry. She has owned 6 real estate brokerages, and in the past 24 years, she has been licensed in 4 states, and she trained and guided more than 600 brokers. This has been an extraordinary life journey so far. Lori comes from a real estate family. She knows just about everything about lending, building, flipping, remodeling, and listing and buying houses. Personally, she has owned in excess of 300 properties, including multifamily homes, single-family homes, resort, and commercial buildings. Lori also loves to train. She loves to coach and share her knowledge with others. When off the clock, Lori enjoys spending time with her 5 kids, her husband Tyler, and their many, many pets. And of course, the rest of the family and her friends. Welcome, Lori, to the Merging Life and Money Show. And welcome, followers and listeners. Thank you for joining in today. So grab a pen and a notebook, as you might want to take some notes to discuss them further with family members, friend, colleague, etc. Because it is about sharing values that could benefit others. So if you have any question or any comments whatsoever, make sure to type them in the chat. And as you may know, the main objective of the Merging Life and Money Show and my very strong why is to empower as many women as I can with what I know about money and finance. So as mentioned a few moments ago, today's show is about real estate investing and how to go about it. So to give some context to today's show, I will say that real estate investing is more than just owning your home or owning a home to generate income through rental income and appreciation, right? There is a plethora of other investing possibilities available, and Lori, the expert, will lead us into what they are. And she will focus on the BRRR or BRRR method of real estate investing, which stands for buy, rehab, rent, refinance, and repeat. So Lori, my understanding is that the BRRRR method is different from the traditional investment property strategy. Please tell us more about it.
So the big difference between the BRRRR method, which is a newer investment strategy, and traditional investing is usually you would save up all 20% to purchase a rent-ready home or with renters already in it, and then you would keep that for 30 years with them paying the mortgage and pay it off. Where with the BRRRR method, it's basically a way to create more income producing properties by putting in some effort. And that's through the rehab and the refinance.
Okay. So clearly you must buy the property first, right? Not just a property, but a distressed one, right? So what is, sorry?
Oh, I was going to say distressed sometimes can mean a couple of different things.
Yeah, that's what I was going to ask you. What does it mean in that context? Yeah.
Yeah. So you want something that has improvement ability, that it's going to improve the value. So you want to be purchasing in an area that most of the other homes are already rehabbed, because you don't want to be the first home in an area to rehab, because that doesn't always mean that you're going to get all the money you put in out of the property. So that's kind of the strategy, where you need to make sure that you're working with someone, or that you educate yourself that you are not getting in over your head on these properties. That's what I've seen a lot of people do. They think they're going to get into flipping, and then they end up keeping the house as a rental. And that's kind of, I think, how this whole strategy started. Was people had put so much money into the flip, they didn't really know how to get out, because they couldn't sell it for enough. So by renting it, they were able to create income and pull out some of the money through the refinance that they had put in.
So am I right to say that that distressed property that you are looking at to turn into some kind of an income may come with a significant amount of risks?
Yes. Having been involved in flipping for now over 15, maybe even more than 15 years. It wasn't even called flipping when I got involved. It was, this house needs a kitchen remodel and some work. Well, one of the problems is figuring out what needs to be done to sell it for the most, or in this case, increase the longevity, so you aren't pouring money into your rentals.
Right.
So you want to make sure it has roof, foundation, things. You want to make sure structurally it's a sound property. Right. And you really want something that just needs cosmetic updates. That's, like a perfect scenario is finding a home that is an estate sale, or someone is moving out to go to a retirement home or a retirement area, like they're retiring to Arizona. So they've taken good care of the property. They've done, electrical updates, the plumbing updates, the, furnace, and things that are going to be costly, but don't cosmetically necessarily sell your home for more. So that's really what you want to find is, perfect scenario.
Okay, so I like to mention that because there is distressed and there is distressed. So let's look at the 4 steps, which happen to start with the letter R.
Yep.
Yeah, so if you could take us through that.
What you want to do after you buy, right, is rehab. And that's going to be cosmetic updates, new countertops, tile work, new flooring, paint, any of the stuff that needs to be done in the house to not only make it more rentable, but to increase your rent. Because people a lot of times don't realize in single family rentals, there is an increase when you have upgraded features for the property. So you really want to research rent in the area that you're looking to purchase and see what those rentals have as far as updates, all of that stuff. So you just really want to make sure that you have done your research on rent, and whether that's you're going to hire a property manager and they tell you exactly what it's going to rent for and what updates to get, or if you go out and do the research yourself, that's up to you. But you want to make sure when you go into rehab that you're not overdoing for the area.
Right. Okay, so you touch on the rehab part
Mhm.
and
And
tell us more about the next step.
so the next step is, of course, to rent the property, because you want to make sure that when you go to refinance, you have rental income to offset the payment. So once you've rented the property, you want to make sure you have your signed contract and your tenants have moved in, or you've gotten the deposit and all the things that your mortgage lender is going to require. Because what you'll be doing is refinancing and doing a cash out refi of a non-owner occupied home. So those can be usually between 70 and 80% loan to value. So when you're doing the rehab, you want to make sure that your value is going to be high enough to get the cash that you put in back out.
Right. So you mentioned something that could be a little technical, a cash out refinance.
Mhm.
And I should put my face when I question.
Just so I am very clear, I'm not a lender.
I understand. Understand.
I just know about this because I've done it, right? So I'm speaking as a consumer on this end. When you go to do your refinance of an investment property, they of course want to look at your credit score. They of course want to look at your reserves, but they also want to see the rent from the property, which is why you rehab, rent, then refinance. Because now you can also do the BRRRR method on multifamily and 5-unit plus, which gets you into commercial. So lending on those gets a little bit more technical, of course. So I'm going to kind of give the broad overview right now. So it's not, totally all the information, but it's enough to kind of get you going. So on anything under 4 units for that one property, you will be able to do conventional financing. And you will be able to offset your payment. And depending who your lender is, they can offset 75 to 95% if you have a rental history on the property, however long it's been rented, or how long your lease is. So they will hit you with a vacancy rate, and then you have to qualify for the difference in payments. And you also want to make sure that you have the reserves and all of that in order to qualify for the property.
Right. Yeah.
Yep.
Yeah. So that's kind of so you know what? I was looking at it, and we talked about it a few weeks back, and in my mind, I had it as you buy the property clearly, then you refinance. So you rehab it first, then you refinance it, and then you rent it. So it's not like, so you rent it after the rehab, right? Then you refinance it.
Yep.
Okay.
And the purpose of the refinance is to cash out the cost that you put into that property. So you want to pull enough cash out, but still have your payment below what your rent is, because you don't want to be losing money on any properties. You want to really set yourself up. And that's where the research on the rent in the area comes in extremely important. So after the cash out refinance, the goal is to repeat it. That's why you take the cash out, so that you have that cash to again purchase and rehab another property.
Right. So I'm looking at some comments coming through, and I have this here. So are there opportunities to invest with someone else who is doing this?
One of the things I do, I work with new investors all the time, and a lot of times I'll purchase with them, because people always think, oh, you're telling me about this, but do you actually do it? Well, I do, right? So I'm one of those people who puts my money where my mouth is. And if I think it's a great deal, bringing in partners not only mitigates my risk, but it also gives them an experienced person to work with. Now, do I recommend that you go out and just search for any investor to do this with? No. You want to make sure you're working with a trusted group of investors and people that have done this before, have the knowledge, have the contractors, have the contacts, understand the rents, understand the areas in which you're purchasing. So all of those things are very key pieces to this.
Mhm. So I want you to take a look at another question
Sure.
before we move on. Um, During the last pandemic, a lot of landlords got stuck with tenants who did not pay rent.
Mhm.
So how can you protect yourself against this?
You know, I can't really speak to how to protect yourself against pandemic per se, because I don't think we've really, in my lifetime, we've never had anything like that before.
Correct.
One of the ways that myself and other investors protected themselves against losing all the rental income was helping our tenants find rental assistance, also applying for PPP loans. So there were ways to mitigate your risk so that you were not as hard hit as some people were. And a
Mhm.
lot of people just didn't know the resources to reach out to in order to get help. So, yes, of course, being a landlord, there's always the risk of tenant damage. And, you have homeowners insurance, there's insurances and things that you want to put in place to make sure that you are protected as you can be, because
Right.
of course,
Okay.
nothing is zero risk, especially real estate.
Mhm. Totally. So tell me, with the movement in the real estate space for the past, I want to say, almost 2 years now.
Mhm.
How how has it been? I mean, has it been an opportunity for such type of investment?
Absolutely.
Yep.
There's definitely been a huge increase in short-term rentals.
Mhm.
So you have investors right now, they're some of the cash buyers, because right now in my market, we have about 30% of the market. And that's, lower in some areas, higher in some, but about 30% of the market is cash buyers here.
Mhm.
And the average sales price in the Seattle area is not low. So, I mean, we just had one in Bellevue go $1 million over list price, and that was less than $2 million,
Pardon
which
me, a million over listed price.
just happened again. In Kirkland, it actually went almost 1.5 million over, and it started at 1.5 and ended up at 3. So it's not low priced. And so when you look at that and you realize that there's cash investors, a lot of these investors are doing short-term rentals or long-term rentals. So if they're willing to put their cash, because they're not using this method, they're
Right.
just, here's the money. I'm not an investor like that, just so we're clear. I'm not going out and spending $3 million on a house for a single family rental.
Yeah.
But there are people that are doing it. So the market for rentals in this area is extremely strong. Amazon just raised their minimum wage to $350,000 at corporate headquarters. And so here, our real estate market is not slowing in the slightest.
Okay, so that is good news for anybody who has some deep cash pockets at the moment, right? It can capitalize on the current market conditions.
And right now, trying to purchase off market, I had a cash investor that I work with. I wrote a $1.65 million all cash, no contingency, letting one of the estate representatives stay in the property for as long as they wanted. And it was not on the market. And I got outbid because there were multiple offers on a house that was not on the market.
Oh, really?
Mm-hmm. That's the market I'm in. It's great.
I see. So tell me, when it comes to those distressed properties again, I have to go back there. What because the property has to be appraised, right?
So
how does it work?
Depending how you buy it.
Okay.
So you can buy hard money that can help cover part of the cost of the rehab. You can also, when you're purchasing right now, There can be what's called a 22 AD, where the buyer agrees to pay a certain amount above appraised value if the appraisal comes in low. Those are pretty standard in our market right now. So yes, it would need to be appraised, but a lot of times what you do is you agree to pay a certain amount. Like, depending on the purchase price, it can be anywhere from 10,000 up to, I've seen them as high as 200,000 cash out of pocket in terms of low appraisal. So again, it's another risk, which with the market in the last year, I mean, most places it's gone up 20% in this area. So let's say you bought a year ago and you paid an extra 20,000 on a $1 million home below, above appraised value, you're still sitting very well off as far as equity goes right now.
So there is definitely a method to that madness, right? to say the least. Yeah, but that is amazing how the real estate investment has taken a different turn. Okay, very much moving away from what you would call the traditional strategy of. So do you see clearly there's an uptick on that, but are people still are they favoring the BRRRR method to the conventional method?
Right now, I see a lot of investors doing this method because it kind of gives them a way to hold on and build more equity in rather than flipping and selling, and then you've just made that small profit and then it's gone. So they're kind of capitalizing on flipping, but still holding on to the equity growth in the property.
Right.
So that is for a lot of investors or a lot of people who were into flipping. And right now they're like, well, if I have to pay X amount over appraised value right now, I'm not going to be able to cash out right now, just turning it in 3 months.
Right.
So people are adjusting to the market, but this has been around for a little while where, people didn't want to just necessarily flip it and then let it go. Because I will tell you, there are certain houses when you flip them, you kind of fall in love with them and you're like, no, I need to hold on to it, because me personally, I put a lot of personal touches onto my properties that I flipped. And sometimes it's tough to just walk away.
Yeah, we seem to have a very interested listener here. And the next question that is being asked is, how do you manage all the properties? Do you have a property management firm helping you?
I hate property management. I will own it. I grew up, my grandfather owned a ton of rental properties, and I collected rent for the first time when I was 3 years old. I feel like, at 44, 41 years of doing that is more than enough. I do hire property managers because there's just time is money. And like I said, I mean, I have 5 kids. I don't want to spend time, letting someone in who locked themselves out, dealing with a broken pipe, and property managers manage that. So it's not something I have to do. And I have really great relationships with a lot of different property managers from throughout the years that I've known. And so I really trust the property managers I work with. I get a really reasonable rate. I don't personally manage my own properties. Probably not the response most people wanted to hear or expected, but sorry, I'm not going to lie. I hate property management. So
I can totally understand that. But that is...
But it's not to say people can't. They can manage their own, because some people are great at that.
Right. Yeah, but you have to have a very, very sound and reliable network. And you have to be very flexible and very available because, you're renting, you're collecting the rent. And so you want to keep your tenants satisfied, right?
And I like to travel. So for like my life, it just doesn't work.
Right.
Because I'm not going to leave a kid's practice or something that I'm doing with my children to go take care of a rental property. I'm just not.
Totally, I totally understand that. So, before we close the show, could you tell me, Laurie, what do you see at the pros and the cons of the BRRRR investing method?
So I will give you just my point blank honest opinion on it. Pros, you're holding on to the equity growth of the properties that you have rehabbed. You also are getting your mortgage paid off by your rent, and you should be also getting rental income each month. So those are the big pros. The cons are, of course, if you get a property, you open up a wall and you go, oh no, rats, black mold, just something that wasn't expected. And all of a sudden you've got the money pit. I don't know who else remembers that 1980s movie, but that will always haunt me. I always watch that anytime I'm about to get to a big project because, a lot of times people watch the shows on flipping on TV and they go, oh, it's so easy. Look, in a half-hour show, look at what they did. And it's like, it's not easy. So that's, I think that they really need to work on making sure they have a good team before they just dive in.
Yeah. So, you got one last question we're going to take before we move on. So don't you risk timing if you hit the top of the bubble?
Well, with the BRRRR method, you're doing a long-term investment. So if a bubble pops or doesn't pop, it's really not affecting this process, because as long as your rent is covering the mortgage payment, you're not as concerned about the value, because this is one of those you're going to keep them and pay off the home and then collect the full rent or sell it at that point and really capitalize on 30 years of mortgage payments being made for you.
Right.
So I wouldn't worry about a bubble with this type of process.
Cool. Good. I mean, that is, as it's not for the faint at heart. That's for sure. Okay. And
look at this.
So if you really love real estate and all comes with it, that is for you. I want to thank you, Laurie, for really enlightening us about this type of real estate investment. I had never heard of it until we spoke. You did a presentation a few weeks back, and lots of good information, and thank you for that. So I am going to try. I'm writing down, so I'm going to try and summarize what you said. So today we talk about real estate investing, and the focal point of that conversation was the BRRRR method, which consists of buying, rehabbing, renting, refinancing, and repeating the process. So if done correctly, the BRRRR method can provide passive income and a revolving method for purchasing and owning property rental, right? Rental property. So you must buy a distressed property. Okay, we said that. Then you must rehab the property, right? You must also rent it. And once you got to refinance it, okay, here comes the refinancing part. And you mentioned that a cash out refinance on the property, that's what you would normally use, because with that type of refinancing, you transform your equity into cash, right?
Part of it.
Yeah, part of it, yeah. And you could get access to your equity by refinancing your mortgage and borrowing even more money than you own, right? So, and then the fund can be utilized to start again. So I think I got it. I understand how that works. But again, as I said, you got to love it. And It's not, as you mentioned, the half an hour show, like everybody sees and said, "Oh, we could do that." No.
Mhm.
So very, very interesting process. Thank you, Lori. This brings us to the end of today's Merging Life and Money episode. And before I forget, Lori, tell the audience how they could contact you should they need to or should they want to. And I have some information that I could run at the bottom there, but you may want to add if they could find you on the social media
Of course.
round. Mhm.
Lori Parker on Facebook. My real estate team is Epic Home Team at EXP.
Mhm.
And then if you go to YouTube, my husband and I have a YouTube channel that's Epic Estates.
Mhm.
And so it combines his estate sale company and my real estate. So it's like Estates, Epic Estates. That's
Yeah,
what
this
we're
is
for.
like a match made in heaven.
We'll go with that. Yeah. we both just say it's a very epic life. Like we
Yeah.
do not have a boring life. Like
Yeah.
there's always something happening. So it's fun.
Yeah, I'm sure. I hope listeners and followers that you have enjoyed today's show. And as you know, I like to end my show with a quote, and today's quote is from T. Harv Eker, and it reads, "Don't wait to buy real estate. Buy real estate and wait." So thank you, Lori, for your awesome contribution to the show today. And for more information about how to achieve financial wellness from the inside out and live a purposeful life with the money you have, join me next week, Thursday at 5 p.m. Pacific Standard Time, 6 p.m. Mountain Time, 8 p.m. Eastern Time, 9 p.m. Atlantic Time for my Bermuda Pips, and 10 a.m. Friday, Brisbane, Australia time for my Australian friends. Thank you for being here today on the Merging Life and Money Show. I am your host, Marie-Jo César. I will be back again next week. Until then, continue merging life and money. Bye for now.